lot of people ask, when is the cycle going to change? When is the market going to harden? Well, I do have a date for you. The market's going to harden May 15th of this year. So you can write that down and take that away. The real answer, nobody really knows. I mean, there's a lot of forces impacting the industry, as you can see on this slide. And let me just talk briefly about each of these and how we see it impacting the industry and perhaps what might be coming next. 2011, we had 26 cats for Main Street. We usually have about half a dozen. It was the costliest year ever for natural catastrophes. I don't know if you realize global economic losses were $380 billion, which were nearly two-thirds higher than in 2005. If you remember 2005, we had the devastation from Katrina and Wilma. 2011 was a lot worse, and we might not think about it in many of those terms because there wasn't necessarily a group of really major hurricanes. There was Hurricane Irene that hit the U.S. East Coast. But if you look at the last point, U.S. cat losses hit a record, $105 billion versus $101 billion in 2005. It was just a terrible year, a lot of tornadoes. For those of you in Missouri, if anybody has been to Joplin, it looks like a nuclear bomb went off in that town. They really got hit hard. Tuscaloosa. Winter storms, just a series of terrible events throughout the year. And that's reflected when you look at the industry financial results, kind of reading from left to right, 2008 until to the 2011 forecast. We all know it's been tough to grow. You've had a hard time growing the last couple of years. Companies have had a hard time growing. You can see from 2008 through 2010, the industry shrank from a premium standpoint. Good news is we do expect a slight uptick in the forecast for 2011, and 2012 is expected to be even a little bit better. The bad news, though, is the combined ratios, which haven't been great from 2008 through 2010, are not going to be good in 2011, and there are a lot of really ugly numbers out there that a lot of companies are reporting. The 109 might be a little bit optimistic. However, there will be a small return on surplus. You know, the persistent lack of growth has caused what many carriers have been doing to fight for business. They've been reducing prices to try to gain market share. And then you also have the added issue of catastrophe losses, which have added quite a bit to the combined ratio. The investment markets, nobody wants to live through what happened in 2008. If we think back to that year, the stock market lost 37% of its value, and you can see the rally in the Treasury market because people were trying to find a safe place to put their money. And then you can see the reversal in 2009 when people were willing to now go back into some more riskier assets. The stock market, muni bonds, things that had wide spreads, did very well in 2009. And then you can see, fast forward to 2011, the stock market was really flat. It was a great year for the bond market, but going forward with interest rates where they are, it's hard to imagine investment income is going to be very good. So carriers found themselves to be overweighted in equities prior to 2008. Many of them deleveraged. The problem with that is you have to have a good combined ratio because your equity part of your investment portfolio is the enhancer to your return. And if you take a lot of that away and have to live on your fixed income portfolio, you're not going to have as much investment income. So companies are going to have to emphasize underwriting profit. Now, if there's anything that may slow down any kind of a market turn, it is the industry capacity. Surplus, as you can see, was rebuilt quite nicely after 2008 into 2009 and 10. And even as bad as 2011 has been from a CAT standpoint and combined ratio standpoint, we still will add a little bit of surplus. But the third line is the one to really pay attention to. When I came into the business, a leverage ratio of 2.5 to 1 was considered acceptable and would get you probably an A rating from AM Best. And now look, the industry is at 0.78 to 1, below 1 to 1. So the industry has a lot of capital, has a very, very low leverage ratio. So industry capacity really has prolonged the cycle. But pay attention to the last bullet point. Since 2008, the industry has released over $50 billion in reserves, which have actually improved the average combined ratios by about 4 points. So that slide I showed you with the combined ratios, even in 2011, if you take reserve releases out, that 109, you do the math, becomes a 113. And we think that many of the reserve redundancies are probably going to be running their course. Reinsurance capacity in economic conditions, global reinsurance capacity declined approximately 5% in 2011, due to the global catastrophe activity. More significantly, though, January renewals, we just put our program to bed. We went over and talked to the reinsurers in the fall. We knew it was going to be a difficult year because back in February, I don't know how much you folks are aware of what happened in February, where RMS, which is the biggest modeling company, made a change to their models and essentially penalized companies that were writing more inland because they said there's a greater propensity for damage inland from many of the experiences that they learned from Hurricane Ike. So it really hit companies very hard as renewals came up this year. And then, of course, economic uncertainty. We have an economic environment that is a bit difficult. High unemployment continues to stunt growth. Obviously, this is what you face every day. Reduced payrolls with many of your customers, fewer new home starts. Maybe some good news, though, is vehicle sales seem to be trending upward.